Well, the economic uncertainty in Europe could be a sign of more volatility to come here at home. Joining me now, Kingsview Asset Management CIO and Fox News contributor Scott Martin, and Nicholas Wealth Management CEO David Nicholas. It's great to have you both here. And Scott, your initial read on markets today, new quarter, new month, final quarter of the year.
New frontier, maybe, Cheryl. I mean, honestly, I think this market is due for a nice bounce. I like how you and Connell set it up. My goodness, is Connell so good at his reporting, I'll tell you. And he's laughing right now, I'm sure, at me and with me in the sense of this is getting laughable as far as how the markets and bearishness is completely going wild. And your setup is perfect about relating it to '08, relating it to all this fear and anxiety out there in the banking system or something to come. Do people forget what happened after '08? Yes, we had to get through it. There were some terrible things there. Bank failures, homes being repossessed, all that stuff. People, remember, leaving the keys on the doorsteps. But my goodness, after we got through this storm, we got to a much better place for the markets and for the economy. And I think this is no different. We've talked about this all year about how when the markets go down like this, Cheryl, as they had a terrible September, as you noted, the expectation for a future return in the stock market, S&P, Dow, NASDAQ, go up. So instead of people selling, as they want me to do for them as an investment advisor, we're trying to get people to leg in here because of the fact that I think things get a lot brighter than they do darker going forward.
Because, David, those of us that have been through multiple cycles in the market, I can personally tell you I've been in this market for about 30 years myself. I will say this, that markets go up, they go down. That is the way that it works. Having said that, one piece of good news could bounce this market out. You know, today notwithstanding, but one piece of strong good news could really change trajectory. And if you're bailing out on the markets, as Scott's clients are trying to do here, you're missing that bounce up.
You know, it's such a good point. And just to add to that fact, I mean, it also depends on where you're at in this life cycle. Because if you're someone that's approaching retirement or you're in retirement, this is it. What you have is all you've got to last you through the rest of your life. It's a little scary, right? It's easy for us to say, oh, don't worry about it. Just go ahead and buy, even though that's the right advice. But it's understanding that really this is all some Americans have, and it's a scary time. But Scott is right, Cheryl, you're right as well, is that as humans, we have this thing called recency bias, where we just assume what's happened recent will continue, and that's never the case. And we always say you want to be buying when it feels like the world is falling apart. And if you're someone that's selling today, when are you going to get back in? When the market's higher? Well, then that didn't work out too well. Are you really going to get back in when the world is worse than it is today? Most people can't do that. So I agree. We want to stay invested, but we may want to own companies that pay us dividends. And so we're big believers right now when we get through this market volatility. Let's own stocks that pay us to own them, and we'll get back to growth at another time. But now's the time to be paid to own equities.
High yield dividend payers, Scott, that is certainly that's a group that's been talked about. Also look at some of the sectors that are the most beaten down. Think about, you know, look, the financials seem to be kind of coming back a little bit. Look at consumer staples, healthcare. I mean, there are sectors in this market that are need-based, maybe not consumer discretionary, but there are groups that you could probably invest in now and feel good about.
Yeah, I like the dividend play. I think it's getting a little crowded. It kind of reminds me of the energy calls that a lot of people are making back in June. Energy having a great day today has been crushed over the last 3 months. And that seemed like the easy trade. So we do have some dividend plays, but I'm just thinking more towards that growth area stuff that's been depressed. And David mentioned something really important. It's a psychology game now. And we talked about this jeans thing going on at the end of Stuart's show and the lead into yours today, Cheryl. Are we going to buy those jeans, whatever price you want to pay for the Carhartts or maybe Joe's or maybe in my case, Bugle Boy jeans? I don't know if those are still around anymore. Do you want to buy those at $100 or $50 or $20? I'm buying them when they're on sale, and that looks like the stock picture to me right now.
Yeah, because we're seeing a change in spending. Real quick, David, to you, we're seeing a change in consumer spending because when we got that data last week at the end of the week from the federal government that basically told us that spending had increased, but people were spending on health care. They were spending on items that they needed. They were spending on food. They were spending on gasoline. This wasn't people going out and saying, I want to buy a new pair of jeans. This was people saying, I've got to go out and pay higher prices for the things that I need to live. That's the difference between consumer discretionary and what they need to survive.
That's right. I mean, when fuel and food takes up more than 50% of your household budget. That's tough. And if you're a young family today that you're raising kids, it's even tougher. So yeah, we're seeing an impact in earnings. And again, I have a rosy outlook, but we still have to think about the downgrades that are probably coming in earnings for the very thing that you just mentioned, Cheryl, as consumers are changing their spending habits, where maybe we're not going to go out and buy that $2,000 or $1,500 new Apple iProduct because now our groceries are twice as much as they were just 2 months ago. So I think we're going to see some of those downgrades happen in earnings, which is why I still tilt towards value. I don't think the tech play is there just yet. I think we're going to have a much better buying opportunity going into the first part of next year.
It was reported on Friday by the Wall Street Journal that Apple has told suppliers, cut back. They're not going to be producing as many iPhones as planned. It's about 6 million units because the demand isn't there for the new iPhone 14. That is exactly your point, David. And the data and the company backs you up on that. Scott, David, thank you very much. Appreciate it.